This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Barry Ritholtz. And for those of you not familiar with Barry, he wrote a great book called Bailout Nation. And his blog is one of the top blogs around, which you can find at ritholtz.com. So I'm going to go ahead and jump right in. And I think you're going to see that Barry and I have had a chance to spend a little time around each other before. So please excuse our familiarity.
Hello.
Hey, Barry, Mike.
You were right on time.
Well, what the heck? What do you think I was going to do? Like, show up late or something, or goof off, or?
You were precisely on time.
I mean, I'm calling the master of the universe up there in the city. I can't make you wait.
I am. We were talking about Sopranos in the office. I am literally watching the last 30 seconds now of the. It's a 3-minute clip of the end of the show.
This is just how you decided to wake up today?
No. We were just because we've been talking about retail sales and the whole macro bullshit about it, and we're watching and why the story is crap and blah blah blah. And I mentioned Entourage, and then we started talking about why would you buy a DVD set, and I said, well, I only buy the stuff I haven't seen, so I don't really need Entourage. I saw all of them. But I watched all of Californication on DVD. I watched all of Weeds on DVD because I never saw them.
Yeah. California. I think Californication might be one of my favorites. That has to be right up there.
I love Californication, and I'm amazed that nobody else got it. It does not have a big viewership.
Yeah, it's interesting. I mean, because Duchovny is so good. I mean, he's just so good.
He's great. He's great in it.
It's kind of funny.
He's just awesome in it.
I saw this thing where Tim Ferriss talks about writing books, and he'll put something on loop, like some kind of something like Pawn Stars or something just on loop that you're comfortable with. I actually wrote a book last summer, basically watching Californication on loop. That was how I wrote the book.
No kidding.
I wrote
I don't like to have language in the background. That's what I love jazz for. I could put jazz on in the background and just essentially ignore it.
Yeah, Ferriss makes some argument about it being soothing and very, very similar. If it's something you're familiar with, it kind of, I don't know, this whole process. But so listen, my idea today was to try and get out of Barry Ritholtz, not exactly what we might talk about at lunch in Vancouver at some odd Indian restaurant, because I don't think a lot of that can actually be on air.
Well, it can for me. It can't be for you. You'll ruin your rap. You don't want to damage your sincerity cred with the girls.
Well, thank you for sticking the Red Hot Poker square into me. Thank you. Let's move on. Let's not even go into any hints. But we were
recording. Is this actually part? I thought this was the pre-discussion.
Well, I don't know. What's the difference? I don't know.
I don't want to blow your chance.
No. This is
streak across northwestern America.
It's not live, so we'll if there's anything crazy, we'll bleep it or something.
Okay.
But anyways,
what do we want to talk about today?
You said
the
that
whole information management is really that I forwarded you is really a fascinating topic. So if we want to,
I'd love to get into that actually. There. Yeah, I mean, you had this piece on your website called "The Price of Paying Attention," and
exactly.
It was a bunch of questions that someone had asked you, and you kind of gave responses.
They were completely unprepared for my answers. You can, sometimes when someone gives you a question and you stop and you give them a deep, I don't even want to say existential, but a meta answer where you actually think about the issue and very often approach it from an angle that they never anticipated. And, it's always fun to blow someone's mind that way. It's like, oh, I wasn't really thinking about that. Well, I think about that. Otherwise, it's just a waste of time.
Well, let me give a little bit of an overview when I look at the Ritholtz landscape, and maybe maybe part of your audience maybe doesn't necessarily know this about you. See, you're a very quant guy. I mean, and you've got a lot of views, you've got a lot of opinions. However, you're not a guy that's going to sit around and fight the tape. And I would venture to say that there's quite a few people that are very fond of you that might not understand that nuance completely to this day, even after perhaps following you for years.
The giant pushback that I got when the Dow 6800 call happened, and that wasn't a market forecast. That was strictly what's the fair value of the Dow. At the time, it was near 14,000. And I basically looked at every component and came up with what I thought was a reasonable assessment of their future earnings for the next 4 quarters, and calculated the Dow based on that. And I came up with, hey, based on our macro expectations of an ongoing housing slowdown and blah, 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 blah. And I came up with 9,800. But I also said, hey, if we break 10,000, the psychology of that is going to cause a 3,000 point excess. And so that's how we came up with Dow 6,800. The whole point of the exercise wasn't a market forecast. It was, hey, what's the fair value of the Dow? The pushback on that was astonishing. And it was nothing along the lines of, I don't think you're giving proper value of housing relative to the major money center banks, or you're not appreciating how much further oil can run. It was strictly 6,800. That's unfathomable. And all you have to do is be a student of the history of the market to say, hey, we've been seeing markets cut in half on a regular basis. This happens all the time. Doesn't happen every week, but look how often just in 2000, the NASDAQ was slashed 81%. So why is it unthinkable that the Dow could be cut in half? That sort of willful ignorance of what just happened less than a decade ago. Forget 73, 74, forget 87, forget, going back to 29. This is less than 10 years ago, and yet people fought it. And then the flip side of that was when we made the bullish look, to me, the bottom calls are much easier than the top calls because first, I don't know when the market tops out. That's a gradual process, and it's when people sort of lose interest, as opposed to a capitulatory bottom where every metric you look at is pinned like those old VU meters on stereos, all the way in the red, all the way to the right side. To me, the bottoms stand out much more clearly than the tops do. And when again, it wasn't like a bold call. It was, hey, the market's now down 57%. History shows us that whenever the market is down 50% or more, on average, the broad market, not a given sector, and the NASDAQ is essentially a sector, on average, the snapback is about 70%. And the pushback from that was just insane. Oh, you're a perma-bull. How am I a perma-bull? When I said 6,800, you called me a perma-bear. You don't get to be both permas. You want to accuse me of one or the other, you can, but you can't say you're a perma-bull and a perma-bear. That doesn't work. So it's always fascinating that, and this was strictly a quantitative call. This wasn't a, gee, I think, I feel, I hope. This was, we've been 100% on cash all year. How many times have you seen somebody make a really good call and then blow it? And I remember having a conversation with my partner in January saying, Kevin, whatever happens, don't let me be that asshole that at Dow 6,800 says, okay, we're going to 3,000. If you're really bullish, I want you to let me know, because I don't want to be the guy that I'm the macro top-down guy. He's the bottom-up guy. So we try to meet in the middle, and the irony is that I flipped bullish about 2 weeks beforehand. So it's just one of those things. The data was pretty overwhelming. There wasn't a single metric that wasn't at such a radical extreme that, and even then, by the way, we never tell people jump in with both feet. you have to assume a high possibility that you're wrong. So the way to do it is you scale in, you deploy 25% of your capital here, and you wait a few weeks and you wait for a confirmation. You put more money to work, and the idea isn't to go all in at the low. That just is a statistical low probability bet.
Let me give you an example that I think you can sink your teeth into before we jump into some of this blog post that we were talking about. So one of the favorites, and I've seen you talk about this in the last couple of years in Vancouver, is gold. And I know this morning you were probably out tending your crisis garden before you came to work. But you
tomatoes and gold bullion and meals ready to eat and bottled water. Is that what the crisis garden?
So you once you're prepared.
No, that's not me.
Okay,
the most I do in a crisis is make sure that both the car and the boat have a full tank of gas. That's about as far as. Although before the hurricane, we always have bottled water, lots of batteries, lots of flashlights, lots of dry food, Parmalat, stuff that doesn't need refrigeration, and you fill your freezer with freezer bags full of water, which will keep a fridge or a freezer cold for 5 or 6 days. If you lose power, we lost power 11 days, so it didn't matter if you didn't get thrown out.
Well, here's my reason to bring it up, gold. So, there's in the last bunch of years with all, the economy up and down, volatility, and, people can't help but be inundated by the, you must buy gold. Everything's going to go to hell in a handbasket and yada, yada, yada. Well, you and I both know as students of history, as students of market charts, as students of price behavior, we can think back to the 1980 time period, and we can see that markets can go way up and they can come way down. And I think, and you've made this case and I'll let you run with it, but I think what's happened with gold is people, it should just be a trade. There should be an entry and there should be an exit. It shouldn't be something that you're attaching your emotional well-being to.
There's little doubt about that. Look, there's 3 things people need to remember about gold. Number one, how the hell do you value it? With stocks, you have a cash flow, an earnings yield, a dividend yield, a P-rate. There's a lot of ways to value an individual equity or a bond for that matter. You have a credit rating, a coupon, or a yield. You can look at it historically. You can look at it versus its peers. Gold is strictly a commodity that trades on supply and demand. So anytime someone's buying gold, you are participating in the greater fool theory. Some people argue the same is true for equities. But if you're buying either a dividend yield or a discounted cash flow, there are certain reasonable statements that you can make about that. You can't make about gold. It's shiny, it's yellow, it has some industrial applications, but it's mostly a store of value and a form of jewelry, and pretty much you can't say, well, gold is worth X relative to all these other things. There's been no correlation. Second, and perhaps most significantly, take gold to the local gas station, to the supermarket, and try and buy something with it. It's not exactly a medium of exchange the way it was when the Sumerians were using it. So, and if things really get bad, one of my neighbors is a gold bug, and I once said to him, what may be the single most obnoxious thing I've ever said to a gold bug, which was, we were at some neighborhood event, and he was just going off. And it's like, listen, when the shit really hits the fan and, you'll be trading your 16-year-old daughter long before you get anything of value for gold in the post-apocalyptic wasteland. So, let's not pretend that in the future this is going to have any real value if you're truly a doom and gloomer and end-of-worlder. And then the last thing is, I keep hearing people talk about, well, I want to own gold because I want to opt out of the financial system, and I don't want to, be beholden to Goldman Sachs or to Ben Bernanke or to anybody else. And again, it's that same, if you think you're going to be in a Mad Max type of world, well, then you better have some handguns and some ammo, because if things get that bad where there's no financial system anymore, essentially it's chaos, and that's not the bet that I'm willing to make.
So it's not Hunger Games and Jennifer Lawrence clones everywhere? Is that what you're telling me?
I see the attraction of buying into that thesis, but I also see that there are too many people with too much money to allow that to happen. There's a reason a lot of these millionaires like Warren Buffett and others are arguing for higher taxes. They're very happy letting enough money fall off the table, enough crumbs fall off the table to prevent the unwashed masses from revolting. So I just don't think that the ultra wealthy would tolerate a Hunger Games scenario. They don't want to just live behind gated community walls. They want to enjoy the fruits of what they've accumulated. I just have a hard time imagining that taking place. Now, you could say the same thing about Soviet Russia, and look what happened there. I'm not sure it's really the same situation.
Yeah.
Between Europe and South America and the United States, I think there's too many moneyed interests to allow the Hunger Games to happen. And besides, we have the NFL and McDonald's. There's the bread and circuses that keep the masses entertained.
Walmart and Target too, though. So let me interject something here as people are listening to this that may or may not know you. Barry is pretty prolific. He's on all the shows. His website, Ritholtz.com, The Big Picture. And he writes a Washington Post column too. And for those people not familiar, I want to read, because recently had Ritholtz Rules of Investing. And I'm not going to read these all, but I want to read the first one. So as people are listening to this, they have an idea that even though you're a very opinionated guy and you have views of things, your number one rule is cut your losses short and let your winners run. So I just want people to keep that in mind as they're listening to us, that you might have opinions, but you have a strategy, a basic strategy for making money that starts with that number one rule.
That's right. I wrote something up first, I'm a big believer that anybody who only reads financial media is missing out, and that you really need to be a little bit of a forensic accountant, a bit of a historian, certainly a human psychologist, and a little bit of a trial lawyer in order to be a really good investor. So that's number one. John Williams, CNBC, just walked in. Hold on a sec. Hey, you want to be on the radio? So that's number one. Number two, I put something out a couple of years ago called Strong Opinions Loosely Held, or Strong Opinions Weakly Held. And the thought process is, if you have a belief, if you have something that you strongly have an opinion about, every statement, every belief, every opinion you make should have built somewhere into that a error verification or a truth or falsity statement about somewhere within it. So in other words, whatever you're saying, whether it's about an investment or this or that, you have to have some recognition of the significant possibility, indeed the high probability, that you're going to be wrong. And so if you go into anything where you say, here's my belief, I ask this question to people all the time. So what would prove you incorrect? At what point do you what's your stop loss? Where do you take your losses? With the stock, it's pretty easy. Hey, I'm short Apple at $17 and it's $6.50. Somewhere between $17 and $6.50, you better have a line in the sand where you're going to cover. On the other hand, if someone says, I think the economy is slowing and housing is getting worse, well, what's your line in the sand? Where do you move away from that? I've been saying I don't really buy the housing recovery, that it's a stabilization, primarily driven by ultra-low Fed rates, but also we had 2 years where the money center banks voluntarily stopped foreclosing while they settled their various disputes with the government, including the robo-zoning disputes. And I said, and we should start to see foreclosures tick up over the next couple of quarters. September up 1%, October up 3%. If I don't see by March that that's continuing to go up significantly, I will change my view on the housing circumstance. But whenever I make that statement, hey, here's what the housing recovery people are missing, I have to build into it, and here's how I know that my analysis, observation, et cetera, is wrong. If you don't have some degree of recognition of the high probability of being wrong, the market will humble you very, very quickly.
Yeah, I think that's it's really well said, because like I said, I think there's probably a lot of people that are fans of yours that might not appreciate that aspect of you. Let me jump into this price of paying attention, though. I think this is really interesting because you are a guy that consumes, or at least to the outside observers, you consume a lot of information. True, false? How is that going? What's the progression? How do you see Twitter today?
Twitter is fascinating because Twitter allows me to hire 700 of the smartest people I've met around the world, and I get to say to them, tell me what you think is interesting. Sometimes it's just an amusing aside. Very often it's some unusual piece of research, writing, analysis, something like that, that I very likely would not have come across on my own, and I get to, you have to be careful when you're drinking from the fire hose. So let me step back and give you a fascinating little piece of information, and this was part of the presentation I made in Vancouver this past July. We run into a lot of problems with information as investors because we seem to want more and more and more data. And that runs into two problems. First, when you spend a lot of time and energy researching something, you have the classic sunk cost fallacy, where you don't want to sell something because I know the company, I know all its products, I know its management, I spent all this time researching it, and I've read all these reports and blah, 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 blah. Now you're almost committed. By the way, that's a scam. That's a classic game that car salesmen use. When they're jerking you around and keeping you there for hours on end, it's not because it really takes that long in the manager's office. They're going back there and smoking cigarettes. They're not actually discussing. Everybody, they know what the car costs, and they know what they're allowed to sell it for. There's not a whole lot of debate. The more time they get you committed, the more likely you are to go with them because you've spent so much time with it. Same is true with a given stock or any investment. But the other factor, and this is really, really significant, it turns out that to make an informed investment decision, you need about this much information. I'm holding my fingers 2 inches apart. And yet people get this much information, and now I'm holding my arms 3 feet apart. And why do they do that? It's not to have more information in order to make a decision. It's in order to have enough confidence that they've done their homework, that they can emotionally be happy with their decision. And study after study shows that all that additional reading, all that additional research, in addition to the sunk cost problem, also creates a high degree of overconfidence. So, and overconfidence leads to bad investment decisions. So we have this bizarre opposite effect of the more information an investor has about a given investment, the worse their returns are, because at that point, they're not getting all this additional information that's helping them make an informed decision. They got to that point 14 research reports ago. All they're doing is assuaging their conscience, salving their emotion, and allowing themselves to be overconfident, which leads to bad decision making. So that's the whole idea about really being cautious about what you bring in to your universe of reading material, and why you should be really, really selective in what you watch, what you listen to, what you read. A friend of mine sums it up very simply: hey, turn the damn TV off and read a book.
Yeah. And
there's truth to that.
Why don't you take, for example, the onslaught, and to me it seems like it's accelerating, and I don't care whether one's on the left or the right or in the middle. The political information, which seemingly for the average viewer out there is tied to their financial well-being. It seems like the onslaught of political information is becoming even more overwhelming than it's ever been. And I just wonder how the average Joe out there trying to take in this megaphone of voices that are being screamed at them on a daily basis, and then try and make a decision for their retirement 30 years from now. It really seems like the information overload is, I guess we can get more overloaded, but it's politically, in the way the politics is tied to the economics and the financial decision-making these days, it really seems it's going to become a disaster area.
It's a combination of misdirection and fabrication. So let's start with a couple of things that people will recognize, hopefully, as more or less true. You'll get some pushback about this, but you'll see that a lot of my opinions are based on data, analysis, facts, studies, etc. It's not just an ideology that I'm finding. In fact, I like to think of myself as pragmatic, not ideologues. I mock my supply-side buddies and my libertarian buddies and anybody who has a book that they can go to as opposed to paying attention with their eyes, and even your eyes can be fooled. So I really I'm somewhat circumspect when I look at these things. So first, study after study show that presidents and politics, but presidents in particular, have far less control over the economy, the stock market, the what have you, than people give them either credit or blame for it. You know, you look at the return Bush generated over the course of 8 years, everybody thought this guy was going to be the new Ronald Reagan, the savior. It was awful. And meanwhile, Obama comes in, everybody thinks this guy is the end of the stock market, market's double. You know, Reagan gets a lot of credit for the recovery from 82 to 87. The 87 crash had nothing to do with him. The recession in 1980 started before he came in, just like the recession in 2000 started before Bush came in, and the recession from 07-09 started before Obama came in. I think guys like Reagan and Clinton were pretty lucky to come in when things were doing well. Guys like Bush 1 and Bush 2, for that matter, had some bad luck, although I probably give Bush 2 more blame for what took place during his presidency, because in some, on my list of people to blame for the financial crash, Bush 2 and Bill Clinton are like number 19 and 20 out of the top 30. So they're not the top of the list, but hey, when you're the president and you do certain things, you have to take certain responsibility. That, such as the war and the tax cuts and all these other things. But that aside, all these presidents get far too much credit and far too much blame. They're not driving the economy. That's consumers and the private sector are. They're not producing goods and services. That's what corporate America and indeed the rest of the world are doing. So that's fallacy number one. Statement number two, and this is key, the cable news networks have 24 hours a day to fill. And I have to tell you, there ain't 24 hours a day worth of news. Most of the stuff that happens is fairly meaningless. Just flick on any channel. In fact, we've discussed this before. The most important data points of the month, non-farm payroll, it's irrelevant. The longer-term trend of payroll, are they expanding, contracting? That's significant. But this is an example that I gave in Vancouver. So in the United States, there's 310 million people. Now you back out the kids, you back out the retirees, you back out the people who aren't working, and housewives and students, and you're left with a labor pool of about 150 million. Of that 150 million, approximately 2.5% to 3% a month will change jobs. So that means about 4 million people will leave their jobs, and another 4 million people will start a new job. Very often it's the same 4 million people. And the difference between the people leaving and the people starting is anywhere from a few 100,000 or so every month. That's the data point that everybody's talking about. Wait, 150,000 is the net difference between the job leavers and the job starters out of 150 million in a month? Who cares? It's a teeny tiny rounding error. 150 million, I don't care about 100,000 or 200,000. And yet everybody on the financial press talks about it like this is it. It's the second coming. Oh, P.S., the number gets, adjusted and we get a new version of it 2 months later, and then it's benchmarked 8 months later, and then it's revised a year later. The actual number that's released on the first Friday of each month, not only is it relatively insignificant, it bears no resemblance to the final number. And yet, if you flick on financial television, this is the shit. This is it. You have to stop what you're doing and pay attention. CNBC used to have a counter in the lower right-hand corner in hundredths of a second to non-farm payroll number, like it's Usain Bolt running the 100. Just the single stupidest colossal waste of time you've ever seen, and that's what they have to do. They have to fill their time. They have to fill their time with all this stuff. So not only is most of the stuff filler, not only is it, shredded cardboard and plywood, then there's the whole issue of the people who come on. You don't get their track record. There's almost no accountability. Very few shows, and there are one or two, but very few shows say to a guy, hey, the last time you were on, you had to sell Apple at 300. It's 700. What's your next recommendation? There's none of that. It's basically, thanks for coming, bore us with whatever your stupidity is, and maybe you'll go get some business out of it. It's pretty fascinating. There are exceptions to that. There are definitely exceptions to the rule, but by and large, if you never flick on another television, it's not going to impact your performance. It's not going to impact your returns over a long period of time. I've heard some traders say to me, I want to know what the masses are thinking. I want to see when Maria Bartiromo is panicking, when she's running around with her hair on fire. But, you're a human, and you get infected by that stuff. It's better to be quarantined than to actually have that as part of your, day-to-day existence.
Yeah, I think it's been foisted onto people to believe that you have to consume all this stuff, and that somehow or another, it's all coming across the screens, and you take it in and you do something with it. You consume it, and I guess that's the sheer act of consumption that seems to have gotten, the other side of the coin, the individual that's sitting there taking it all in, and this insatiable need to consume.
So that leads me to the flip side of consumption, which is quarantine, and that was in the piece that you mentioned earlier, which basically the cost of paying attention, which is basically when you find someone who is just god awful. And look, understand, Ted Williams hit 400. He was the greatest batter of all time. You can't expect people to get everything right. You can't expect people to be perfect. But is the analysis legitimate? Is the judgment? I use Larry Summers as my favorite example of the single dumbest smart person you'll ever want to meet. He's like a really high-powered processor with crappy software. He may be book smart, but the guy's got the world's worst judgment. And if you look at pretty much any decision he's made, which has led to him relentlessly failing upwards, you'll say, I just want to be on the other side of any trade he's making. So I look at people, and there are lots and lots and lots of people talking on TV all the time, writing in publications, working for major firms. And at a certain point, you just say, this guy's a money loser. Not only am I not going to read him, I want to willfully stay ignorant of anything he says, because he's just, and I could give you lists of dozens and dozens of people.
Barry, what's a process you get to the point where you eliminate somebody? What's part of your process where you eliminate somebody or something from even coming across your screens or whatever?
So there's a great little app called followupthen.com, and you send a mail to yourself. And you send, let's say you set up an account, and there's a free version and a paid version, and you could send them any email with a date in it. So if I want to be reminded about something in March, I'll send something to the email address is march@followupthen.com. If I want to be reminded Thursday, it's Thursday@followupthen.com. And so very often when I see something that strikes me as odd or unusual or weird, I'll put it in my calendar, but also send a follow-up, send something, a reminder to followupthen.com, and then I'll forget about it. And 6 months later, I'll get an email. Now's the time to, short XYZ, says this article, or here's why the GDP is going to 6%, or something like that. And, now you said this then. The people... a perfect example are elections. I'm not as I'm a political independent. I'm probably socially progressive and fiscally conservative. I voted Libertarian this year, but I was astonished at the poor process that so many people used to make an evaluation of the election outcome. And I wrote something on the blog back in September saying, look, I have no expertise in politics, but I do have some background in mathematics. And rather than cherry picking, because I would get emails from people, Rasmussen has Romney up 5%. Yeah, but Rasmussen's got a terrible track record. Instead of cherry picking and exhibiting the confirmation bias that we all suffer, go to Real Clear Politics, click all polls, and there's the average of all the polls, and you'll lose the left-leaning bias and the right-leaning bias, and you'll get the average. Oh, and by the way, Nate Silver, and this was back in September, Nate Silver has a great track record. If you want to follow one analyst, I would tell you he's the guy. If you don't want to follow anyone, if you just want to crowdsource it, Real Clear Politics has all polls, and that's an intelligent way to go about it. But I kept on getting emails from people, and how wrong is Barron's in the Wall Street Journal every election? They just tell you it's all wishful thinking. And here's the key. This isn't about politics. This is about the cognitive process and how people, investors or political junkies, instead of doing what's right in front of their eyes with price and time and sales, they're giving you their hopes, their wishes, their dreams. You can't make money on that. You have to look at what's actually going on in the price action to either confirm or deny what reality is. Now, look, markets get skewed on a regular basis. Sometimes they're way too cheap. Sometimes they're way too expensive. The trend is your friend, but you have to add the corollary, except for the bend at the end. That's very much the case. But when I see somebody that is consistently wrong, showing a consistent bias, showing a poor process, that's the key. It's about the process, not the outcome. It's okay to be wrong. It's not okay to stay wrong. So the Johnny One Notes, the guys who are saying the same thing over and over, it's almost as if the actual input of the data is irrelevant. They have their belief, and who are you going to believe, me or your lying eyes is the sort of expression that comes from that.
It's funny. I as a long ago political science major, I didn't really follow this election too closely. And but for those people out there that don't really understand this, there are people, and as you're correctly pointing out, that quantify this, have the statistics upside and downside. And I will guarantee you, and you know this too, there were people that knew exactly what the election numbers were going to be to the T. They knew in advance. They spent, and the numbers were there for people that, as you say, wanted to see the numbers. And I'm not.
Silver was one. Votomatic is another. The guy at Princeton is a third. A lot of people who are quant and mathematical driven just nailed this dead.
Yeah. Yeah, it's interesting, but that's something I think for the average person, not unlike maybe my world, the trend following world, and some of the quant thinking that you have. A lot of people that you want to put your opinions and you mentioned this in this blog post too, and I'd love for you to run with this, is the value of intuition. I mean, so many people think that their intuition, when it comes to these numbers driven fields, that their intuition will get them over the hump, and it's just not true.
There are so many ways of disproving it. The money hole example makes people crazy. There's lots of different ways, but you have to be brutally honest with yourself, and you have to recognize your own confirmation bias, your own selective perception, your own tendency to retain things that agree with you and casually forget about the things that disagree with you or the bad trades. I used to sit in a boardroom, in my office off of a boardroom, where we had 800 guys, 800 brokers, and I would sit and do portfolio reviews with them. And I would hear this over and over again. I don't understand why my numbers are so bad. I have this stock as a home run. I have this as a winner. I have this. Oh, well, let's do a weighted average and put it into the spreadsheet. And you'd come back and say, all right, your biggest position is XYZ. It's down 80%. It's a piece of crap. Your second biggest position has done nothing. The market's up 20% this year. Your third biggest position is this. It's underperforming. And, you know what? You had Apple, but you sold it 500 points ago, and it was your 18th biggest position. So what? And you know what? Here's another thing. You said you own XYZ, and that's a home run. you had so little of it, it didn't impact. Your biggest holdings are junk, and the couple of winners you had, you sold too early and they were too small. But even when it's in black and white, they continue to scratch their head, and I just don't understand. Well, stop buying crap, and here's what you need to do. Buy less of the losers, hold on to your winners, and look at the spreadsheet every day. You should have a P&L that you're looking at so you know. If you don't want to look at it every day, look at it every week so you understand exactly where you are. If you don't know your numbers, you're just driving with a blindfold on. You can't do that. But the cognitive process of humans not wanting to be confronted with their underperformance or their errors or, every time I give a speech to a group of mom and pop investors, I always start with the same thing. The single best advice anybody can give you is dollar cost average into a group of broad indexes. Don't try and time the market. Don't try and stock pick. This should be boring. If you wanted some entertainment, go to Vegas, go see a Broadway show. This should be boring and dull. P.S. None of you are going to follow this advice. And everybody laughs. And then the next 20 questions are about, what about Apple? What about this? What about that? It's hilarious. But people do this for entertainment, and they're just not interested in recognizing, or at least many of them aren't interested in recognizing, there's a simple way to do this, there's a complicated way to do this, there's an ineffective way to do this. We're going to do the most entertaining, not the most, efficient and effective.
Let me throw something out. I'm going to circle back to, but since I got you on the line, you got such good views. And if you haven't read Barry's book, Bailout Nation, you should. I think the title right off the bat tells you that there's been some problems and perhaps some moral hazards that have been created that are ongoing to this day. But Barry, where do you see us right now? If you had to I'm not asking for a prediction or anything. I'm just, as you take in everything and you look at, we've got interest rates at 0%. You got the Dow basically at 13,000. The USA Today, I've seen this week, it seems like every front page story is like, it's good times are here. And isn't there a side of you that's just, when you see interest rates at 0% and you see all this QE stuff, how do you take in all this? How do you view this world that we exist in right now, other than, hey, let the profits run and have stop losses in?
Well, a couple of ways. First, I still think the United States is a dynamic, self-correcting system that, despite the socialism for the corporate types and the removal of the normal process of capitalism, i.e. when you're bankrupt, you go to bankruptcy court and they either sell off your pieces or dissolve you. That's what capitalism is, not, hey, I'm a banker that knows a politician, therefore I'm going to be able to tap the taxpayer. One of the things I do every year is go to a couple of tech conferences, especially those that are primarily populated with young tech entrepreneurs. And when you go to these things, it changes. You can't be a doom and gloomer seeing what's coming down the pipeline from the next generation. So that's number one. Number two, I'm a big believer that economies and markets and indeed entire societies move in these long cycles. The example I give all the time, World War II ends, 45 million GIs return. We have the GI Bill, all those guys go to college. Eisenhower builds out the interstate highway system. Civilian aviation is really developed. The rise of suburbia, the rise of the automobile culture, the electronic industry. So, not a shocker from 1946 for the next 20 years. You have this booming economy that just rolls and grows, and the market, the economy, society, everything moves forward. But eventually that cycle comes to an end. It gets ahead of itself. It gets narrow. You end up with the Nifty 50. You end up with societal dislocations with the rise of the women's movement and the equal rights movement and demand for equal rights by minorities. And instead of just giving it to them, which is only the right thing to do, there was a lot of fighting about it. And then you had the next cycle, and that next cycle was a down cycle until you had Vietnam and Watergate and the oil embargo and all these things coming to a head. And so the Dow hits 1,000 in 1966, And 16 years later, 1982, it's still under 1,000 with lots of ups and downs. It's not until after 1982 we get past that. And then stop and think about the next cycle. So 82 to 2000, mobile and semiconductors and software and internet and technology and the rise of biotech and, on and on. You have this giant booming economy. It lasts 18 years. And then we, again, get ahead of ourselves. And from 2000 to, I don't know when the bear market that began in 2000 ends. I jokingly say it stops sometime between next Tuesday and 2017. But if history holds, somewhere in that zone is when this ends and the next major cycle will start. So I try and put stuff within the context of the really, really, really long term. If I could capture most of the long cycle, meaning during secular bear markets, I'm heavily weighted towards lower risk or riskless assets, and I'm not leveraged, and I'm not in anything that can blow up on me. I'm really biding my time waiting for the next 1982. That's where you start, and then you start drilling down and say, what sectors are working, what things are likely to start the next 10-year or 20-year cycle. So to me, that's biotech, that's healthcare, it's anything involved in consumer electronics and technology. I don't try and guess who's the winner is going to be. I like to use broad indexes. I mean, who the hell can pick any given biotech stock? I don't know what the next FDA approval is going to be, so you buy the index, and I think that's a space that's going to do really well over the next 10 years. You have something like 100,000 baby boomers retiring every day. You could buy the ETF for healthcare, and these people are going to be continuing to consume lots and lots of healthcare. That's a sector that's going to do really well, and it's relatively cheap. These sound like forecasts, but they're really not. I think they're just, hey, what are the vectors? What are the trends? Let's assume the trend is going to continue for a couple of years. Eventually, most of the baby boomers will retire, and it'll be time to probably move out of healthcare, probably before the last baby boomer retires. However, there's still lots and lots of, a decade of that at the very least. And I don't know when biotech runs to an end. I wish there was a way to invest in nanotech, I think, and clean energy. There really isn't a broad index that allows you to buy a little bit of all of that. Those are areas that are possibly interesting over the next decade. And look at a variety of different broad things that are currently working and are likely to continue to work going forward. And I don't mean the next week or month or quarter. I mean, I want to think out a decade or so. And sometimes that takes you to odd places you wouldn't really expect to go. But, look at countries like Brazil and Vietnam. These are areas that potentially are going to be significant players in the global economy 10 years from now.
By the way, I start the Asian excursion on February 1st, so I'll be there for at least 4 to 6 months. So nice. You might have to stop by if the family will let you out of the house to visit your favorite insane trend following friend in Asia.
I would love to do a Vietnam, Thailand, Singapore, Hong Kong sort of trip. That's on my bucket list.
I land in Bangkok February 2nd. So one of the things I want to kind of, as we wrap up here, I think people should really appreciate, and they might have heard it in the very beginning, they'll have heard it in the beginning of this podcast. You were talking about watching The Sopranos this morning. And, a lot of people will wake up each day and let's say they're focused on making money. And maybe they've gotten so rigid and so lost in this goal of money that they don't even have a life anymore. And to some degree, I think you're a great example of that, where especially people read your blog, they realize you have a lot of disparate interests. You're not just this guy who's this, lost in the screens quant guy. And I think it's a great example. And, we've spent some time around each other. It's a great example of trying to lead a life and not just sitting around dreaming every waking moment about making the next dollar through the markets. And I think that's a really important lesson that if people can take from listening to you and watching and reading your blog, I think it's really important.
I always like to let other people pay for my tuition, meaning if I can learn from what someone else has done instead of going through the painful process myself. Ben Franklin, I have a quote of the day on the blog, and it's randomly pulled from a list of quotes I've assembled. And today's quote is, "Experience is a dear teacher, but fools will learn it no other," by Ben Franklin. Meaning, hey, you don't have to go through the painful process of experience to learn something. You can learn from other people. And because of what I do for a living and work with a number of, ranging from ordinary mom and pop to absurdly wealthy people, it's given me an opportunity to try and figure out lessons to be learned from them. So it was a year or two ago, I wrote a piece for the Washington Post. I always like to have an evergreen piece ready in case whatever I'm working on that week doesn't work out. And this piece was Lessons from the Very Wealthy. And I got really bizarre pushback from so many people about it. But exactly what you're talking about is 7 Life Lessons from the Very Wealthy. It was June 2011. One of the things that kept coming up when I was asking some of these billionaires and multi-hundred millionaires about what lessons they would share was, if you spend your whole life pursuing wealth, but you don't, you miss your kids growing up, that's a bad thing. Having money is better than not having money, but if you're cash rich and time poor, stop and think about what you get for your labor. You trade your time for your dollars when you're younger, and then when you're older, you trade your dollars for time. So all the things you pay for, it's because, well, I could, mow my lawn, but why do I want to spend an hour? I could pay someone $30 a week to do that, and I don't need to waste. I can make more money in the hour than I could mowing the lawn. So unless I really like mowing the lawn, why do I want to do that? So one of the things that I thought was really interesting was if you get so caught up in the competitive nature of your job, trying to become partner, trying to make that next million, you ignore your spouse and you end up divorced, or you miss seeing your kids grow up. There's no value to the money there. It's not about money. It's one thing to talk about security and having cash that pays for the benefits of modern life and that buys some security. That's very different than just chasing money for its own sake.
Yeah, I think you hit the nail on the head there. I posted a video, and you've probably seen this, but it was from the philosopher Alan Watts, and what if money was no object? And it's the same type of thinking. Like if you get so caught up in it, and you transfer that caught up feeling to your kids, and your kids grow up the same way, and it just becomes this vicious cycle of seeing how long you could sit at the 9-to-5 desk cube, and then the next thing you know, as I've been saying on my podcast a lot recently, hey, guess what? You're gonna die. So you better do something with that time other than just try and make money.
It's true, and look, the old joke is money can't buy you happiness. It could just pull up in a big yacht next to happiness. That's certainly a realistic possibility, but it can't be the be all and end all of everything. You have to have another goal. Yeah.
Well, listen, we're going to have to do another one of these podcasts, but we won't do it until at least something magnificently crazy and unexpected. Some swan swims in and there's something, something crazy has happened. We're in a very calm period right now. We need something insane to happen.
It's out there. You can smell it. It's definitely coming. You just don't know when.
Yeah. Hey, Barry, listen, thank you. Listen, for everybody out there, Ritholtz.com. Bailout Nation is Barry's book. And hey, if you want to help promote this tomorrow, I'm very close to breaking 100,000 listens for the month. So I'll send you some.
Shoot me the link and we'll put it up on the blog.
Okay, great, Barry. Listen, we'll talk soon.
All righty.
Take care, man.
All right, take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.